ensuring your organization is prepared for any challenge. With our governance services, we strengthen your decision-making process, promoting transparency and accountability at every level. Our performance management solutions empower your organization to achieve its goals by aligning individual performance with strategic objectives. Join the many organizations that have benefited from our tailored solutions and expert insights. Choose Brandmore Advisory for a brighter, more secure future. Visit our website at www.brandmore.com or contact us at 011-0263-052 to learn more.
All right. Good morning once again. Thank you for joining us for today's webinar. I'm Hazel. I'm going to be your host for this webinar. Okay. Today we are tackling navigating SARS compliance, what companies need to know. And your speaker is Tatenda Chasakara, one of the tax experts at Brandmore. He's going to walk us through this topic. And if you have any questions, we're going to deal with them right at the end. Just going to briefly go through who we are. Once again, we are Brandmore, a dynamic and professional accounting firm that is based in Midrand. We have branches in Zimbabwe and the UK, and we call ourselves accountability partners because this is what we live by daily. Our services include secretarial services, consulting, audit and audit readiness, internal audit, payroll services, human resources services, tax services, as well as accounting services. I'm going to hand you over to Tatenda Chasakara, who's going to go through this pertinent topic with you. Thank you.
Hey, thank you so much, Hazel. Morning, everyone. Hope you're all having a good Friday. As Hazel introduced me before, my name is Tatenda Chasakara. I'm one of the accountants, and I also deal with tax here at Brandmore. So today, what we're going to be covering specifically regarding the need to knows for companies and separate legal entities when it comes to taxes and SARS. The first thing we're going to cover is obviously identifying the companies or the legal entity types that are subject to corporate income tax. The second thing would be how do we then submit these taxes once we've obviously identified that we need to pay them, what we need to be aware of and maintain throughout the year when it comes to preparing for the tax bill and determining how much it is that is payable. We're also going to cover provisional tax. And the very last thing, which I'm going to break up into three parts, is essentially looking at the applicable company tax rates that companies are subject to, as well as the perks and benefits that companies can look to, I guess, take advantage of when it comes to trying to reduce their tax bills. All right. So before we get started, we are going to run a poll in the background just to get to know our audience that has joined us this morning. So it's going to run in the background. Just let us know who you are, like, are you a business owner, an individual, a CFO, et cetera, just so we can get to know the people that are joining us on this webinar today. Okay, let's see next slide here. Okay, so first thing that we're going to look at is obviously identifying the companies that are subject to corporate tax. Right. So subject to special rules and exemptions, usually all companies and legal entities are required to pay tax or at the very least declare. Right. So as mentioned earlier, we're just going to go through essentially all of that and determine which companies are required to essentially pay taxes, corporate tax specifically. So if you look at a sole proprietor is not considered a separate legal entity when it comes to our South African company and tax law. So as a result, they wouldn't be subject to corporate tax. However, sole proprietors would have to pay for the taxes of that business as part of their normal individual tax return, right? Trusts, although they are obviously all trusts are separate legal entities. They wouldn't register with the CIPC. They are registered with the Master of the High Court. They would be subject to income tax as well. However, when it comes to trusts, there's usually special rules, so they wouldn't necessarily be subject to corporate tax. However, there are specific tax rules that apply to them as well. Then you have your personal liability companies, which are your incorporated companies, such as Brenmore, for example. They would be subject to corporate tax. You have private companies, public companies, closed corporations, foreign companies. Foreign companies would be subject to only tax for the locally South African sourced income. So if a foreign company sets up a branch or a division in South Africa that, for example, sells clothes or something of that nature. So only the income that they generate from those activities for that local branch here in South Africa would then be subject to to corporate tax here in South Africa, right? Then you also have your state-owned companies, which would also be subject to corporate tax. You have your non-profit organizations that register as companies. Those would also be subject to corporate tax. However, they could apply for an exemption if they qualify to be a public benefit organization. And then non-profit organizations would also be subject to corporate tax. But same thing with MPCs, that they can then apply for an exemption to be considered a public benefit organization. So something before I move on to the next slide is, if you are essentially a separate legal entity or a company and you find that you are not necessarily liable for tax, chances are you might still need to declare the fact that you are not liable. So what I mean when I say that is that, say, for example, you have a year, maybe you made a loss and there's no tax payable for that year. Although there's no tax that you may need to pay to SARS, you would still need to file a return that says, I've made so much income, I've made so many expenses, this is the final amount, which is a loss, therefore I don't have to pay income tax. So that's something that's very important to remember, that even though you may be exempt or may be in a position where you don't have a tax liability, you will still need to declare that to SARS as a company or a separate legal entity, right? And now, speaking of SARS, now that we've assessed to say, okay, I am a trust, I am subject to tax and special rules, or I am a private company and I'm subject to corporate income tax, how do I then go about submitting these particular taxes to SARS? So there's two ways to do it. The first way is to go to a local SARS office that's near you and submit your return to SARS manually. Right. The second option would be to do a electronic submission via e-filing. So this can then be set up with an e-filing profile. And one of the fortunate things is that here at Brenmore, we can assist you. One of our services is to assist people with setting up an e-filing profile for their company so that they can make their tax submissions electronically. Okay. And now we look at what it is that what it is that you would need to be aware of if you have a company or a business or an operation when it comes to obviously submitting your taxes. So the first thing to know is obviously the tax submission due dates. When is this tax due, and when are the payments due? Right. So for all those entities that are subject to corporate income tax, which is your ITR 14, your actual corporate income tax return is due within 12 months after your company's financial year end, all right? So if your year end is December, it's due the following December. If it's Feb, it's the following Feb, right? Then you also have provisional tax, right? which is due every 6 months. So you have your first provisional tax submission that's due halfway through your financial year. You have your second one that's due at financial year end, and you have your third, which is an optional provisional tax payment that you can do if you wish, which is due usually 6 months after financial year end. So using the example of a company whose year end is in Feb, right? So March 2025, I'm operating. Come August 2026, I submit my first provisional tax submission, and if there's an amount payable there, I pay it. Come Feb 2026, I then obviously submit the second return, and if in Mar if in August 2026, I feel that maybe the taxes that I've paid through provisional tax is a bit too low, and I want to top up my taxes before I make my final big submission. I can then opt to do that third optional submission for provisional taxes, and then come Feb 2026, I then submit the ITR 14, which is the income tax return for my 2025 financial year. All right. Okay. Then you have trusts well, income tax specifically for trusts. So this one normally, I say it tends to be a bit of an exception because trusts to a certain degree are almost treated the same way that individuals are. So under normal circumstances, trusts would, similar to companies, pay or submit the tax return within 12 months after year end. But this deadline can be extended to January if it is filed electronically on e-filing. One thing I want to obviously note out is that the January extension only applies to trusts that have a year end of February. So under normal circumstances, a trust default year end is February, but you can apply to have a different financial year end. If your year end is February, you get that January extension. If your trust financial year end is different, then you don't get that extension, right? And then obviously in terms of preparing the information for these tax returns, you obviously need to maintain the financial records of your company or your separate legal entity. So the income, the expenses, your assets, liabilities, and all the supporting documents for all those transactions and balances in case SARS comes back and makes an inquiry of any nature. Okay. So earlier I had mentioned provisional tax. So when it comes to individuals, we obviously ask the question whether an individual has to sign up to be a provisional taxpayer. When it comes to companies and separate legal entities, you have to. There's no rules that exempt you from provisional tax. If you are a company, if you're a separate legal entity, you have to sign up for provisional tax. And the reason why SARS set up provisional tax in the first place is to minimize the cash flow burden of actually paying for your taxes when the final big submission comes. So it's the ITR 14 or the ITR 12T, right? So instead of saying, so say for example, you have a company you've been operating, and your tax bill now adds up to 1.2 million. So instead of having to pay that 1.2 million all at once, when the ITR 14 is submitted, you can pay that ITR that 1.2 million in installments over 6 months during the course of the year, so that come year end, when you submit your actual return, you say, look, my declaration is 1.2 million. I've paid 1.1 million. Here's the extra 100,000 that I owe SARS. So it's just a means of easing the cash flow burden for companies when it comes to your provisional tax, when it comes to your income tax specifically, income tax returns. All right. Now the next thing that we're going to look at is obviously the tax rates as well as the company perks. So I did mention earlier that I will be breaking this up into three separate parts. So the first thing that I'm going to look at is the applicable tax rates that companies are subject to, right? So the first thing is you obviously have your corporate tax rate, which is usually the default tax rate that companies are subject to. And that is at this moment, it is 27% of your taxable income, right? And then we have something that is classified as small business corporations. So depending on how much your taxable income is, you are liable to pay either 0% or up to 27% on your taxable income. So how to determine whether your company is a small business corporation or not? There are specific requirements that need to be met, which I've listed on this presentation as well. So if your gross income is less than 20 million, all your shareholders are natural persons, so they're actual people. It's not shares held within a company being held by another company or trust or anything like that. And less than 20% of the income that that company generates is not from investments and rentals. So when you say investments, you're looking at specifically assets that would bring you, for example, dividends, interest, royalties, that type of thing. So if less than 20% of your total income comes from investments and rental income, then you would qualify as a small business corporation, which will then give you obviously a lower tax rate. So like I mentioned earlier, depending on how much your taxable income is, you might find yourself paying no tax or at most 27%, right? Then the next category that is also available is your micro businesses, right? So micro businesses are subject to a turnover tax table, which is from 0% to 3%. So this particular tax rate calculates your tax on your turnover. So it calculates the tax on your revenue only. It doesn't consider your expenses. It would only look at, say, your revenue is 100,000. So your tax would be 3% of that 100,000, for example, right? So there's obviously, depending on how much your turnover is, would determine in which percentage you would fall in terms of that turnover tax table, right? So similar to SBCs, your micro businesses also subject to specific requirements in order to qualify, right? So your turnover must be less than 1 million rands. You need to essentially operate as a company or a sole proprietor. So a sole proprietor, partnership, closed corporation, cooperative, or any other type of company, right? Similar to the small business corporations, your income from investments and rentals must not exceed 20% of your total income that you earn from that business, right? Then the owner of the micro business must not hold shares or members' interest in any other companies. There are exceptions to this rule. One of them I know off the top of my head is if, for example, if you hold shares in a listed company, that's one of the exceptions. You won't get kicked out of being subject to, you won't get kicked out of benefiting from the micro business tax table. And obviously, the last thing, you mustn't be a personal service provider. And there's also exceptions that essentially apply to that as well. Okay. Then foreign companies would also be subject to the default tax rate of 27%. However, as mentioned below, it would only apply to the South African sourced income. So it wouldn't be the total income of the foreign company, just the portion that they earned from their activities or their business operations being conducted in South Africa, right? Then when it comes to trusts, default to 45%. However, this 45% only applies to the income that is retained or left inside the trust. And then you also have special trusts. Now, special trusts are subject to the individual tax table. So it's a sliding scale from 0 to 45%. And there's certain requirements that need to be met to be classified as a special trust. So there's two types of these special trusts. You have a disabled beneficiary trust, and you have a testamentary trust for minor beneficiaries. So essentially, if you open a trust for your child and they're below the age of 18, along with obviously certain additional requirements, they would then fall into that type B special trust. All right. So now we've gone through the tax tables. Let's look at the tax perks or the benefits to say, look, I have a company. I understand I'm making money in my business, and I understand that there's this tax that I need to pay. But what is it that I can do in my operations to try and minimize that tax burden or how much tax I need to pay to SARS as best as I can, right? So the key things that you need to look at or structure in order to obviously set this up, you need to look at the nature of the business and your operation. So specifically, what industry do you operate in? Because there would be certain benefits that SARS offers depending on the type of industry that you're in. All right. The type of expenses that you incur as part of your operations. Um, because obviously, apart from the tax tables, right, to get a lower tax rate, the only other way to take advantage of minimizing your tax, your tax expense or your tax burden is to obviously look at the type of spend and the type of expenditure that you incur as part of your operations, right? Then you also need to look at the type and structure of transactions and arrangements that your business or your legal entity would enter into. So, for example, if you enter into a loan arrangement or a loan agreement, right? If it's an interest-free loan versus having a loan that bears interest, you can claim that interest that you're paying as part of your deductions to reduce your taxable income and ultimately reduce your tax rate. Whereas if it was an interest-free loan, you wouldn't have that interest to deduct against your taxable income. So you might pay a higher tax amount because you essentially have taken out a loan that bears no interest, right? And then obviously, lastly, when SARS offers these particular tax perks and benefits, there's obviously certain requirements that you would obviously need to check to confirm whether you qualify for those specific benefits, those allowances, or those deductions, right? So examples of these perks and benefits. So the ones that are obviously, I guess, more company specific, we've gone through the tax tables. So generally, you would be subject to lower tax rates, depending on the type of vehicle that you use for your business operations, as we went through earlier. Then obviously, as a separate legal entity, you have the benefit of carrying forward your assessed losses. So, for example, for individuals, if, for example, you have a tax refundable, SARS pays that amount back to you. But as a company or a trust or any other type of separate legal entity, you wouldn't SARS wouldn't refund you that loss that you've made. However, SARS keeps record of that assessed loss so that when you do come to a point where you are making profits and you do have a taxable income, you can use that assessed loss to basically reduce your profits, and you might find that you may have additional years where you don't have to pay tax at all. All right. Then we also have benefits that you can get from your employment skills, from employment and skill incentives. Sorry, employment and skills incentives. So if you set up like learnership programs, SARS does give you a learnership allowance for training your staff. That learnership does have to be CETA approved. There's also the employment tax incentive, which I would say is somewhat indirect because it's not corporate income tax per se. You see it more with your PAYE, but it's essentially a tax benefit that you get for hiring youth, and that youth must be within a specific earning threshold. I believe the maximum is like 6,500 per month, essentially. And then you have investment incentives as well. So if you are a company that incurs research and development costs, and if those costs are approved by the Department of Science and Innovation, you will get an additional allowance or deduction for those specific costs. You also have renewable energy and solar energy as well. SARS does offer additional allowances and accelerated allowances and benefits for that as well. You also have your urban development zones or your special economic zones. Again, you also get accelerated allowances. And if you are doing work or if you fall within the requirements of working in a special economic zone, your corporate tax rate would then also reduce even further from 27% to 15% of your taxable income. Right. Then obviously we now look at capital allowances. So when we speak of capital allowances, these are the allowances that SARS gives you for the assets that you use in your business. So your laptops, your computers, the desks, the tables, the vehicles, um, those particular assets, those kind of items SARS would give you allowances for, similar to depreciation. When SARS speaks of allowances, their equivalent to depreciation is essentially these allowances. So your normal allowances you would fall under Section 11E. But for example, if you are a small business corporation or you are a company that's specifically within the manufacturing industry, you get what we call accelerated allowances, which fall under Section 12. So I have been mentioning accelerated allowances a lot. So I think let me just elaborate what I mean by that. So and if you look at your standard allowance, SARS, for example, would say that let's say because you are operating as a company, you have this particular laptop, you are allowed to write off this particular asset over 3 years. So if your laptop, say, costs 30,000 rands, it's a very high spec laptop, costs 30,000 rands, you would then be able to claim an allowance of 10,000 rands every single year to reduce your taxable income. But if you're a small business corporation, so I'm that company that makes less than 20 million rands in my turnover, and I meet all the other little requirements, because I'm a small business corporation, I get what is called an accelerated allowance. So instead of me now only claiming 30,000 rands, 10,000 rands, sorry, over 3 years, I get to claim that full 30,000 rands in the first year that I actually bought and paid for that particular laptop. So I get that allowance in full immediately, as opposed to getting it split over 3 years or 4 years, right? So there's also other different types of accelerated allowances. Some allowances would say that instead of getting this normal claim, which would be to claim for manufacturing equipment, to say you can claim it over 5 years or 6 years or 7 years, you then can claim 50% in year one, 30% in year two, and 20% in year three. So essentially, these capital allowances, especially the accelerated allowances, try and give you a lower tax burden by giving you a higher deduction sooner rather than later, right? And then obviously, depending on the type of industry that you operate in, you can also get an allowance on the commercial buildings or hotel buildings. So under normal circumstances, companies usually don't get any deduction or allowances for the buildings that they operate in, but there are specific requirements that can be met to get deductions for those particular buildings. All right. Okay. So, right, before we continue, we're going to run a second poll. So just let us know if you do need any help with if you are experiencing any difficulties or you need help, assistance with anything that is SARS related or SARS compliance related. It doesn't have to be just for corporate income tax, anything SARS related. Just let us know. You can give us your details and we could obviously contact you. All right. Okay. Next slide. Okay. Then the last part that I want to go through in this webinar, right, is specifically trusts. So earlier when I had presented the tax rates that trusts are subject to, if you recall on the tax table, so normal trusts are subject to 45% tax, and special trusts would then be subject to taxes similar to individuals. So, I mean, looking at it, from an outside point of view, you would then ask yourself to say, okay, if that's the case, then what is the point or the purpose for having a trust? Because if I hold the items myself, I'm subject to the individual tax rate. But if I put it in a trust, then now all of a sudden I have to pay 45%. Like that's the default tax rate. So what benefit is there to actually having a trust, right? So the thing with trusts is that trusts on their own are generally not necessarily tax efficient on their own. So the best way to take advantage of a trust is to essentially make it a part of your tax or estate planning tool. So what I mean by saying it's a tax or estate planning tool, it's more of looking at it to set up this trust or structure it in such a way that it benefits you when it comes to long-term wealth generation and obviously long-term tax benefits. So trusts are more useful and more handy when it comes to creating long-term benefits and limiting your tax burdens in the long run. And they're not necessarily more beneficial for short-run benefits, right? For short-term benefits, rather. So if you are looking for something that is more short-term, you might find that it actually would be better for you to set up a company or a small business corporation or a micro business. But if you are looking for something that is more long-term, something to benefit, future generations, in your family, then trusts would be the vehicle that you could look at setting up, right? So benefits that trusts benefits that trusts would have would include things like income splitting, as well as reduced capital gains tax burdens. So when we speak of income splittings, normally in a trust, when you set up a trust has beneficiaries, right? So these are the people that are essentially benefit from whatever income generating activity or income generating assets are sitting within the trust. So let's say, for example, there's a specific trust. Trust A has three beneficiaries. Has three beneficiaries, and that particular trust owns a building that it rents out. And in this particular year, the rent income after expenses and all those deductions came to 1 million rand. So under normal circumstances, if that money was left within that trust, assuming that it's not a special trust, right? If that money was left within the trust, then that 1 million rand would be subject to 45% tax, right? However, if I then, in the trust, if we then split the income to the different beneficiaries, what then happens is maybe, let's say, for example, you have one beneficiary who doesn't work at all. So for them, they don't pay any tax at all to SARS because they have no other income apart from this income that comes from the trust. You have someone who's, let's say, for example, works has a job and they are subject to maybe, let's say, their effective tax rate as an individual is 18%, and maybe the third beneficiary, they are subject to an effective tax rate of like maybe 30% or something like that. So if we now then take that 1 million rands of income and split it across the different beneficiaries, then the beneficiaries would then pay the tax on that split 1 million rands as per their own personal tax tables. So you'll then find that at the end of the day, instead of keeping the money in the trust where it would be subject to 45% tax, I would split it to the different beneficiaries, and maybe the effective tax rate or the effective tax burden from that 1 million rands of that rental property ends up being 20% as opposed to 45%. So that's essentially like an example of, the making use of the trust as a tax planning tool to say, where do I then obviously distribute this particular income to minimize the tax burden. And obviously, if you realize that, you know what, it's rather better to keep it in the trust, you can obviously keep it in the trust and it'll be subject to the 45% tax burden, right? Then again, similar rule would work for capital gains tax. So I believe for trusts, the taxable capital gains are at 80%. So you include 80% of your capital gains when it comes to tax. But as an individual, if you distribute, only 40% of it would be subject to tax. Then when we come to estate duty planning, so the last 2 points kind of go hand in hand. So when it comes to estate duty taxes, so if I have a family member, so I've written a will, you've written a will, and you say, look, I'm gonna pass on this property to my children. So when you eventually do pass and the will is written and everything's gone through, your passing away will then trigger estate duties tax, right? Which is normally between 20 to 25% of what they value your property to be. But if you hold these particular assets in a trust, your passing away won't trigger that estate duties tax. All that will happen will be the updating of the beneficiaries or the updating of the beneficiaries in the trust. And essentially, you will set up a vehicle where your all these properties and all these assets which you want to pass on for future generations, as it's being passed on, it wouldn't trigger any capital gains or any estate duty tax or anything of that nature because those particular assets are being held by the trust. So yeah, so I mean, so at first hand, you look at trusts and you look at the high tax rate and you think, oh, this might not be the thing for me. But yeah, I mean, with setting it up and structuring it in such a way that it helps you and benefits you in the long run, you can find that the trust can work to your advantage, despite it being like a company that's set up, and obviously there's the admin and the specific rules that need to be followed for trusts. All right. Okay. Okay, perfect. So now we are going to go to our Q&A session. If anyone has any questions, they are free to just type them in the chat and we can address them. So just want to check here. How much time do we have left? Okay, about 10 minutes. Okay, but about 10 minutes to take questions. Okay, let's see here. Okay. Okay, I see here. So there's a question that's been asked to say, is refinancing on a house taxable? Alright. Okay, so I would assume, so if this is specifically a house, like a personal house, um, if this is like a personal building, so there's no business operations, yeah, you're not using the house to produce income, then in that case, you wouldn't be able to get any tax benefits from that. So what SARS does is that the deductions and allowances that SARS offers, they offer them specifically in the production of income. So if I buy a house for my family to live at, I wouldn't get a tax benefit for any spend on me purchasing or acquiring that house. However, if let's say, for example, I work from home, and what SARS will then offer you is to say, for the portion of that house that you designate and set aside as like a office or a business office specifically for work purposes, you can then get a claim or an allowance or a deduction for a portion, for that particular portion of or section of that house. So if maybe that specific area is maybe like 3% of the total yard space, then your electricity, your financing bills, that type of thing, 3% of that you can then claim against your individual tax, or your, whether it's, yeah, so it's either individual tax return or against the company, depending on how it's specifically set up. There's obviously specific requirements that need to be met to set up this particular section of your house specifically for business purposes, and there's proof you'd need to provide for SARS. But yes, to answer your question in short, you wouldn't get a tax benefit. However, if you can prove a portion of your house is being used in the production of income, then you can get a portion deducted against your taxable income. Okay, so what if I have a tenant or you're running an Airbnb? So in that case, it is rental property. So you are renting it out in the production of income. In that case, then that would then allow you to then get a deduction for the interest on on refinancing that particular building. So in this case, the rental income is you producing income from that particular building. Then you would get the tax deductions from those operations. All right. The last question, I'm not quite sure that I followed, to say how many times can you refinance your house? Because remember, well, no, but I hope I try to answer it, because I guess you mustn't necessarily look at this in isolation to just tax, because refinancing also affects your credit score and all these other things that run in the background apart from tax. So as far as tax is concerned, it would just be the benefit of you getting the deduction on the interest from the approved financing arrangement. But whether how refinancing multiple times, that would be a much more broader question, which is not which is you need to then consider factors outside of tax as well. Yeah. So yeah, so that's yeah. So there's no clear-cut answer for that from a tax perspective. Okay. Hmm. Okay, just want to check. Okay, then let's see if there are any other questions. Okay, in the absence of any other questions, we will just carry on with the presentation. However, if any questions do pop up, can just type them in the chat, and my colleagues will let me know. All right. Okay. And then lastly, if you do want to connect with us, here are our contact details here on the screen for you. So we have a phone number. You can email us at help@brynmore.com with any queries that you have. You can go to our website, www.brynmore.com. Our offices are located in Midrand at the Waterfall Office Park, and we obviously have the YouTube channel as well. Okay. All right. Thank you, everyone, for joining us. I hope this was an informative and helpful webinar. And we hope that you will obviously join us more frequently. And again, if you do contact us through our various channels, we hope to work together with you moving forward. All right. Thank you, everyone. Take care and enjoy the rest of your Friday.